This is Brad Matheny. This is the 17th of April, day before Good Friday, and I am doing this video. I guess I will call it similarities to 2020 COVID collapse. This gentleman or lady, Anvinv, I don't know how to pronounce that properly, Anvinv, wrote this. I apologize. It turns out it's impossible to link a graph here. Is it possible, according to your theory, that the 2020 scenario will repeat itself? Since tariffs are an artificially created crisis, and these are some actions with the market, if I want, I will introduce tariffs. If I want, I will postpone for 90 days or more or less, blah, blah, blah. This tariff crisis can end quickly as it began. However, the course of sometimes something will depend on how much these tariffs hit the economy. For example, there's already been a cessation of supplies to the U.S. of rare earth minerals, vital to a number of industries, but the company's reports are quarterly, and I do not know what reserves the enterprises have. That is the time we will see the economy greatly delayed. So, the summary of this, and you could pause the video to read it, is that, are the tariffs essentially acting like a supply chain disruption similar to COVID, when the entire world shut down because of fear of, the COVID vaccine or the COVID SARS-2 virus. And I will admit, I created this chart to try to show you, I will admit there are already similarities in the sense that we've had a 19% collapse here, which is exactly the same size for the most part of this 34% collapse here, 116 points, 116 points. It's almost exactly the same type of collapse. And again, I've highlighted these issues here. Supply chain function, we are obviously going to see supply chains diminish over the next couple of months, possibly longer, as these tariff negotiations continue to play out. Capital market function is something we have yet to see actually play out. And I do believe that capital market function globally could present a very solid depreciation of hard assets, meaning tangible commodities, except for gold and silver. I think those will continue to rally. We'll take a look at crude oil here in a bit and a few others. But honestly, the shortage of supply is going to raise prices for some commodities, hard assets, but the disruption to the global economy in terms of jobs and shipping and actual supply of, let's call it, core consumer products, could disrupt. I read an article the other day that something like 90% of all toys are manufactured overseas. That could play out come Christmas. That could play out come the end of the year. It could play out, during the summertime. We'll see how much tourist activity actually plays out and whether the U.S. market is capable of supporting the summertime activities. But, it goes both ways. It's a double-edged sword. If consumers aren't spending in the U.S. or around the world, then manufacturers aren't manufacturing and shippers aren't shipping and stores aren't selling. So, it's a domino effect. It works down the line, and maybe in a way it works up the line, but I look at it as a catalyst event, kind of like, think of it as a water sloshing if you put a water into a jar like this, a square jar, and slosh it around, it goes back and then it goes forth and then it goes back and then it goes forth. And that's kind of how I feel this whole process is with regard to the tariffs. There was an immediate reaction, and there's going to be a counter reaction. Then there's going to be an immediate reaction to the counter reaction. And this gentleman or person, let's just say, is probably correct that the similarities to the disruption in the market are yet to really be felt. Now, COVID lasted a lot longer than we expected. I expected, and we ended up having these massive stimulus programs kick in right after COVID to keep the economy going. Are we going to get these right now? Yeah, I think the global markets are going to throw a lot of stimulus out. The U.S. markets, I don't know yet. The Fed, I mean, and Congress, we'll see. I don't think that until we see some sort of a meltdown in the U.S. markets beyond where we're at right now, I don't think we're going to see the Fed really do much. The economic numbers are still coming in pretty solid. We do not have any massive disruption right now. There could be end runs regarding supply factors. So, for example, China could sell to, I'm just picking, but they could sell to Peru, and then Peru could sell to Mexico, and then Mexico could sell to us. Now, granted, that's a still an additional cost as far as coming to us, or they could just, China could just sell to Mexico, and Mexico could import it to us, or something like that. But like I mentioned earlier, the demand for the U.S. economy is tremendous. We are the biggest. The U.S. is the biggest, most dynamic, most aggressive economy on the planet. It is the premier economy. You have 300 and roughly 30, 40, 50 million people that are actively acquiring, widgets, whatever you want to call it, cars, homes. We have a wealth level that is substantially higher than a lot of other countries, meaning that, the average consumer in the United States, spends probably 25 to $45,000 a year U.S. money just trying to live. And you go down into Southeast Asia or other areas, and that's 3-4 times an average annual income in some cases, maybe 5-6 times an average income in some other countries, maybe a lot more. So again, how's it going to play out? I don't know. I do believe that if we take a look at this from a linear regression channel and try to just play it out here, you're going to see that we have this really, we have not broken down yet. Okay. And really, when it comes right down to it, ladies and gentlemen, we would likely have to see some sort of a breakdown into this level here. And try to get this right for you. Well, let me just do it this way. So I'll just click this and increase this out to 3 and -3. This is a 3x standard deviation, and up we'll make it light blue, and down we'll make it light blue. Whoops. How come that didn't work? Okay, up, blue, base, down. Okay. All right. Well, that's fine. I guess that'll work. And the point again, ladies and gentlemen, is that, we would have to see this move down here into this area. And we're not there yet. And we may not be there. Now, my expectation, like I said, if I were to try to draw it for you, my expectation, this is weekly, so I have to be cautious here. We have one more week up, then a week down into the May lows. Then we come back up into this area into June, roll down into the July lows, which should be a little lower, roll back up into this channel. And I'm going to start over. Too tight. So we move up into the weekly high, down into the May lows, up into the June highs, move down into the July lows, move over into consolidation, into August, September, and then move down into the October lows. So we could get there. This is my expectations of where we're likely to go. This is what I believe is likely to happen. And you could see that we could get down to the COVID lows. I think this is maybe a slower train wreck. And I think it's going to play out in the sense that deals will be made over the next 2 or 3 months. So there is a very minor disruption. China and the US obviously need to sit down and really talk about how this is playing out. I understand China wants to keep the tariffs to protect their economy, but I also understand the US wants to eliminate the tariffs to create more of a free market and eliminate, so to say, the US subsidy to China. But there has to be some common middle ground unless either country is willing to risk the downside. So we'll see what happens here. As far as the consumer, we'll see how the data plays out. I mean, we are in this downtrend. I do not expect a low in the markets until we get out here into this October low. I'm really kind of looking at this, we may end up down in this 400 area. I doubt it, but I'm really looking more along this like 480, 500 area to start to rally back up in through the end of the year and into 2026. But in the meantime, we're going to be moving down this channel. And I believe we're going to see this pull back, kind of like we saw right here in more of a downward cycle channel that plays out over, maybe a year, about a year. And it's really going to roll down into these extremes, maybe down kind of like this area here. So I'll draw a line right across this area, give you an example. That may be a very solid low level for the market moving forward. I do expect disruptions. I do expect the markets to roll slightly. Let's come over here and take a look at crude oil. Crude oils that had been, as of last week, 55, moving back up a bit. This is a reaction. Again, this is that sloshing that I mentioned of economic. And this is really, you need to understand that for every action, there's an equal and opposite reaction, just like the laws of physics teach. And that's how the economy works as well. You have an action, there's a reaction. It's kind of like a reversion. So where we're at with this is that, oil, here's the COVID lows. I don't think we're going to get there. We are moving into this downward channel. You can kind of see it right across here. And that would put us down here near these lows. So here we have the potential for July, August, the potential for oil to be in this 50 to 60 area out here come July, August, September, October, potentially as a low. And that would correlate likely back over to these areas pre-COVID. I think that would represent a fairly slow economy, and we can go from there. Let's take a look at the transports. Transports have moved considerably weaker. Again, very similar, looks like, in structure to the COVID low. Very, very close to the COVID low collapse. Again, I think this is going to weaken out. So remember, if my analysis is correct, we are going to roll down, and roll down. So, I don't think that we're going to see a massive collapse. I do think that we're going to probably end up in this area here, kind of like this low area, 4,800. On the transportation index, I think we're going to see weakening trend, kind of like we saw right here. you know, big breakdown, and then consolidation, 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 and then we worked our way out of it. And that would be kind of this move here, down, up, down into an ultimate low, and then work our way back out of it into 2026. Let's come over here to the crash index and get over here to weekly. This is the crash index I've talked to you guys about. You can see we've gotten this fairly big breakdown here. Here's the COVID lows. This is the dollar, freaked out and rallied. The dollar is much weaker right now. We're not getting that rally cycle. This is post-COVID weakening here, so we may be a little bit aggressive through that cycle. This is the SPY at 528.57. And then this is gold over here, just rallying like a banshee. I'll drag this back over and let you guys take a look here. You know, do we have that big breakdown? No, I mean, we do, but we don't. You know, we're not seeing that big cataclysmic downward shift. Remember, COVID hit during a period where the markets were already weakening. Financials, transports, gold, and oil were already weakening through this cycle. We don't have that here. We have strengthening economy. So again, I would ultimately believe that we're going to roll into this area here, down into this area, and then roll back up into 2026. Now that didn't play out right. Didn't quite draw it right. So we are going to roll July, October, and then roll into a move back out. And that plays out very cleanly with my expectations. So come back over here before I run out of time. 17 minutes. I'm going to come back here to the SPY, and I'm going to tell you that, you know, ultimately there are similarities with the supply chain disruption, and they could continue to move further depending on if we get any, you know, broad stimulus from the global markets. I know China is throwing money at it. I'm wondering if others have started to throw money at it now, but I believe they will settle. And again, we would need to watch these four components here. Basically, you can watch the transports, you can watch a combined index capital market function, some sort of a global ETF, global financial, watch the financial markets, and watch consumer function. If we start to see huge numbers of jobless claims and or consumer engagement really weakening and or manufacturing, you know, coming to a standstill, then yeah, we're getting extra signals that we could be moving into a deeper stagnation. But remember, we still have that sloshing. So, you know, if one side, let's call this the minus side, and this is the plus side. If we move from the plus area to the minus side, we're going to get a slosh over here. Something's going to change, and then something will move back over moderately to the positive side, reflecting that we're now trying to balance. In other words, we try to stay in some sort of an equilibrium here in the middle, and then we will slosh back over here. Eventually, we'll balance out, find our equilibrium, and then we'll move back towards the bullish side. That's kind of how the markets work, in my opinion. So we're going to just have to see how it plays out. Very interesting question. Thank you, Anvinv. I mean, it's a very interesting question. A little too early to tell what's going on, but this is my feedback. I don't think we're going to see anything much deeper than this 450, 475 on the SPY. I think that's going to probably be about it. And that would be considered a very deep low. Okay, guys, talk to you later.